Okay. So I think we are live, and I'm making this series just for my own benefits, not just I want to provide knowledge or something. It is that so number one, so number one features, features 47. I think is what? Reading number 47. Security uh, bond pays interest and principal T1, T2, T3, which are private, non-tradable and bonds for fixed income securities. Then our principal par face value, and then on a fixed periodic periods on fixed periodic terms, coupons or interests are paid. Few features are: issuer is a person who borrows, bond maturity principal is repaid less than 1 year, it is money market security more than 1 year, it is capital market security principal at par, it is at par. If it is sells at below the par value, it is discount. Issuer major issuers are sovereign bonds, corporate issuers, entities, and then financial assets and issue backed securities, asset backed securities also we have, and then bonds backed by the cash flows from those assets. So maturity, if it is less than 1 year, it is money market securities. If it is more than 1 year, it is capital market securities. The time remaining until maturity is known as tenor. Time remaining until mature money market, and then bonds that have no stated maturity is known as perpetual bonds. Principal par. So the principal that is paid back gradually over the life. Coupon rate and frequency. The coupon rate on a bond is monthly payments, that is there. And then FRN, floating rate notes or floaters, the variable market rate of interest is known as market reference rate. Floating, okay. So if depending on reference rate plus a fixed margin, the added margin is typically expressed in those of equity investors making debt senior to equity. However, not all debt claims are ranked. Those making debt senior to equity. However, not all debt claims are ranked equally. Senior debt ranks higher than junior debt, also called as contingency funds, the later stage. Bond price and is expected. We calculate the expected return. Bond offers lower yield. As such, price and yield are inversely related. We will perform these yield calculations in later readings. Yield curve, we have yield curve. An upward sloping yield curve is referred to as normal yield curve because this longer dated maturities due to yield curve is referred to as normal yield curve because this longer dated maturities due to higher levels of uncertainty. Yield curve. Less returns. So government bonds are often deemed to be of the lowest credit risk. In bonds where okay. So we are done with A. Covenants of okay, legal contract between both. The indenture defines obligations Often restrictions on the borrower. Sources of repayment. The source of the cash flows required to be paid by the bond issuer depends on the nature of the issuer and type of the bond issue. Sovereign bonds are repaid from taxes on economic activity, and in some cases, so local government bonds are repaid from government local taxes. So this is important. Sovereign bonds are repaid from taxes on economic activity. Bonds are repaid based on economic activity. Taxes on economic activity. The ability of a government to create new currency. This tends to result in sovereign debt being perceived as lowest risk. Okay, local governments are repaid from local government taxes. Local government bonds. Local government taxes or revenue from operational infrastructure. Sources of repayment of a repaid from with added security legal claim. Okay, and then collateral we have this contrast with unsecured bond which is having no claim and is repaid only from the operating cash flow of the issuing company with added security of legal claim. Operating cash flow plus legal claim. Okay. Bond covenants we have. Covenants are the rules, legal rules. Are the legal rules. Affirmative specify requirements the issuer must fill. These may require the issuer to provide timely defaults. If the issuer defaults on any other debt obligation, the issuer will also be considered in default on this bond. Cross default. Default any other debt is equal to default of this particular bond as well. Issuer will also be negative covenants. These can include restrictions on entering into asset sales and leaseback agreements. Pledge on collateral. Company cannot use the same assets to back and then issuance of issues. Our debt by EBITDA is below to back and then issuance of issues. Our debt by EBITDA is below. So until it does a plus 250 basis points. Coupon frequency and is the right answer. Time to maturity and coupon rate. Which of the following statement best describes the sources of repayment? Notes are back. The operating cash flows rely on the operating cash flows as their primary. The operating cash flows rely on the operating cash flows as their primary source of. This is notes, no. The notes are secured. Source of. This is notes, no. The notes are secured and unsubordinated obligations. Subordinated obligations. Notes are secured and unsubordinated obligations. Notes are secured and unsubordinated obligations of secured bonds rely on the operating cash flows as the primary. Secured bonds rely on the operating cash flows as the primary. Not asset-backed securities. C is the right answer. Antelas AG's issuer specific credit spread rises by 250 basis points per annum after issuance. Which of the following best describes how Antelas would issue coupon rate will immediately increase by 25 basis points to investors will increase but will not become effectively will remain unchanged. What is it 250 plus market reference rate plus 1 year after the FRN issuance plus 250 basis points per annum market reference rate plus 250 basis. So calculate the value of Antelas payment to bondholders on the maturity date if MRR is 25 2.5 plus final interest period for the final interest period. So Antelas payment to bondholders on the maturity if MRR is 0.25% per annum. So how is it repaid? 4 years from settlement date. Maturity date is 4 years commencing 3 months to be paid quarterly with the final payment on the maturity date. $2.5 per annum. This is the interest rate, 0.85 quarterly. So, question 5, Antilist decides to raise new secured. How many are? They change. Is the most likely to have coupon payments that reset periodically. Floating rate notes, I don't think so. Convertible bonds, they get converted to equity shares, but how will they get reset? Oh my god, B is the right answer. I don't know, but I disagree. They don't reset, they just change. They reset the rate of entry. Okay, fine. Let's see the important things here from the exam perspective. Okay, fine. Let's see the important things here from the exam perspective. What is this? It is fixed income instruments. Okay, let's go to the next one. Fixed income cash flow. Cash flows fully if it is repaid or partially. Sinking fund provisions we have coupons, and then something that is paid over the top when the last periodic payment is made. Typically automobile. If something is at the end, paid at the end, it is called. We have no the constant yearly term is 213. So this we can calculate here. Let's calculate. Um, Negative is PV. Uh, Waterfall structures. For asset-backed securities and mortgage-backed securities, we have uh, and then we have a few more things to learn here. Sinking fund provisions, that is fine, and then sinking from fund provisions offer both advantages and disadvantages to bondholders. So bonds with sinking fund provision have less credit risk because the periodic redemptions reduce with the possibility of receiving cash flows early and not being able to reinvest them at lower yields, and only being able to reinvest them at if interest rate for mortgage backed securities. These structures can be split into tranches of varying seniority. Common waterfall structure is for junior tranches not to receive any principal payment from the collateral pool. Okay, waterfall structure. So senior tranches and junior tranches, variable interest rates, we have floating rate notes, we have market reference rate, FRN, promises to pay MRR, plus some fixed, and this is expressed in basis specified dates, and then we have credit quality linked to future potential events. Loans to borrowers of lower credit quality leverage loans often have a coupon rate that increases. Then we have credit, that is called as credit linked loan, and then we have payment in kind by increasing principal amount of the outstanding bonds. Cash flows may be less than required service amount. To include the following, we have interest index bonds and capital index bonds. The coupon rate is adjusted for inflation while the principal remains unchanged. An example, capital index bonds, the coupon rate remains constant but principal value index capital indexed. Zero coupons, no interest, deferred coupon bond, regular payments do not begin until a specified time. We have deferred coupon bonds, payment starts after a certain period, appropriate zero large project, and then fixed income contingency provisions. Fixed income contingency provision is contract describes an action that may be taken if an event or something that actually happens. Contingency provisions in bond indentures are referred to as embedded options. Contingency provisions, contingents converted to debt on occurrence of specific event, embedded options. And then we will discuss three types of bonds with embedded options here: callable bonds, puttable bonds, and convertible bonds. Bonds that do not have contingency provisions are known as straight bonds or option free bonds. Callable bonds, issuer has the right to call back call price. Example, can be redeemed 102%. Has value to the issuer because it gives the issuer the right to redeem the bond early and issue analogous to refinance monthly payments. Issuer holding the call option creates call risk for the bondholder. Call risk, call option. Puttable gives the bondholder the right to sell. Price of the bond is less than the book price. Whether to exercise is between an otherwise straight, identical, and puttable equal to the value of the put option to the bondholder. Convertible bonds that can be converted after a certain price. Conversion price. This is par amount at which bond may be converted to common stock. Its conversion ratio is 25 shares per bond. Price of the bond. Conversion value. Thus the market would be received upon conversion. Bond with conversion of 25 shares. 25 into common shares 50 1250. Conversion price is par amount into market value. To attach warrants to straight bonds when they are issued. To buy the shares at 40 when if the value increase above 40. Contingent convertible bonds are bonds that convert from debt to common equity automatically if specific. Describe how foreign bonds, and then we have euro bonds, we have global bonds. If the bonds are issued by the issuer incorporated in the same country, issued to the person of the same country, it is domestic bond. Please. Foreign bond. Issues Okay, this is one thing. Bonds of issuers from countries other than the market in which bond trades are referred to as foreign bonds. UK company raising US bond dollars to expand their US operations is foreign bond. Euro are issued outside the jurisdiction of any one country and can be issued in any currency. They are subject to less regulation than domestic bonds in both jurisdictions. Bond issued by Chinese firm that is denominated in N. Euro bonds that trade in at least ownership by possession. So any person who is having the possession of these bonds will be the owner of the bonds. And then we have registered ownership is by registration. And the special purpose entity we have also bankruptcy, remote vehicle we have that involves more than one country. Eurobonds that involve more than one country are often collectively referred to as international bonds, distinguished between which involve only one single country. So domestic bond is one country, and then international bond if it is more than one country. One country, more than one, then most often the salary interest income from bonds is often exempt from national income tax and often from state income tax in the state of issue. When a bondholder sells discounts, OID, price moves, original issue discount bonds. So if tax to reduce the with balloon payment will most likely have your loan with a lower regular payments, higher final payment. With which of the following features of corporate bond issue does an investor most likely face the risk of redemption before maturity? Face the risk of redemption. Before maturity sinking fund. 10-year bond pays no interest for 3 years, then pays 299 followed by payments of 35 deferred bonds. The following most regularly describes the maximum price for a currently callable bond. Maximum price for the currently callable bond. Call price. An investor cannot go beyond call price. An investor buys a pure discount bond, holds it to maturity, and receives its par value for tax purposes. The increase in the bond's value is most likely to be treated as investor buys a pure discount bond, holds it to maturity, and receives its par ABC. Type incorporate to best mitigate the investor's credit concerns. Consider deferred adding call provision could consider accelerating or linking debt coupon to financial covenants. C. Next, which of the following is the best contingency feature this step could add to mitigate its own concerns regarding lower interest rates? Mitigates its own concerns regarding lower interest rates. Contingency feature could add to mitigate its own price is conversion ratio. Conversion value is equal to conversion ratio is equal to current conversion value divided by conversion price. This derives the implications of removing conversion feature from a bond. Removal of conversion would likely result in higher coupon. Would likely increase the bond price. Would likely result in higher coupon A. Which of the following are most likely to trade at a lower price relative to otherwise identical option-free bond? Lower price putable bond. Huh? Oh, sorry. Callable bond. Yes. Higher. Try to convert to lower yield. Oh yeah, higher yield. Then after conversion, please callable bond. Okay. Company issues 10-year bond on 1st of Jan 2014. Its contract requires that the coupon rate increased by specified yield. Higher yield. Talking only about debt. Specified. Yeah, correct. Step up. Correct. As an investor domicile with an optional discount. Typical investor on the right, commercial paper, money market instruments, unsecured corporate bonds, secured corporate bonds. A is 3, secured is hedge funds. Yeah. Hedge funds, secured corporate bonds is issued 2. Hedge funds, C is 2. Crazy. And issuer with. Cash flows and no. This is next chapter. Okay. Let's start with the next one. Fixed income issuance and trading. So what are important in this one? We have common pitfalls, describe common cash flows, consideration, how principal are distributed over implications, calculating amortizing payments while listed under describing structures, and then we have understanding variable interest and indexed linked bonds. Indexed linked bonds, FR plus spread, how inflation linked bonds work, contingency provisions, differentiating between callable, puttable, convertible bonds, how they affect bond yield relative to option free bonds. Heavy emphasis on comparison, understanding option characteristics and impact on risk and return. Calculating conversion ratio, understanding calculating importance calculation, application bond features, classifying bonds by jurisdiction. Understanding tax considerations, cash flow contingency, regulatory legal provisions. Conversion ratio is equal to convertible bond par value divided by conversion price, conversion value into current share price. Okay, fine. Domestic market. Euro bond has less regulation. Surety bond. Over collateralization, credit cash reserve fund, surety bond, banker, and letter of credit. Okay, fine. This is very easy. So fixed income issuance and trading. This is the third chapter, module 1. Fixed income issuance and trading. Describe fixed income market segments. We have types of issuers. We have sovereign issuers. We have special purpose issuers. We have sovereign issuers. We have special purpose issuers. We have entities ABS. We have asset-backed securities. Investment grade S&P. Major examples of investment grade are AAA down to BBB minus for S&P, AAA and to BBB minus for S&P, through Baa3 are considered investment grade bonds. Credit agencies and are considered investment grade bonds. Moody's bonds. BB plus or lower, BA1 or lower for Moody are high yield bonds, speculative or junk. BB plus, triple B plus is good. Triple B minus is good for S&P. Double B plus is gone case. Moody's AAA, BAA3 is good. Anything like BA1 or something like that is bad. Yeah. Above more than 10 years, we have well-established investment grade corporations may issue commercial paper to fund short-term working capital. Intermediate debt maturities of fixed income are usually segmented to short term. We have long term, we have mid term. Anything that is less than 1 year is money market. Mid term, more than 10 years is long term. We have treasury notes, more than 10 years is treasury bonds. Repo, we have unsecured corporate bonds. Unsecured corporate bonds, asset backed securities is mid term, 1 to 10 years. Mortgage backed securities is more than 10 years, and then we have secured corporate bonds and leveraged loans. So repos here are referred to sale and repurchase agreements, which we'll describe in the later reading. For now, it is enough to know that repos are short-term asset-backed securities. Secured corporate bonds appear in the high yield category because we are referring to new issues. Companies with less reliable cash flows will have to offer security to investors when issuing debt. And now, bad. It is fallen angels. Fallen angels. Previously it was good, but now it is bad as fallen angels. Bonds, ETFs will position according to their stated mandate. Investment grade intermediate securities excluding treasuries, asset managers seeking high returns, financial intermediaries across whole countries, interest rates. Then we have fallen angels here. We have syndicates offering credit facilities, syndicate of banks. Describe types of fixed income indexes. More of index is having, it's called contain broad selection of bonds. Broad selection of bonds is known as compare primary and secondary market income to new bonds. So we have a public market, private placement, underwriting, best efforts, and grey market. When the assets are sold to aggregated investors, it is called as, it happens in primary market, whereby issuer sells new securities to investors and receives new capital. Yeah, it is called as private placement. Both are usually carried out through financial intermediaries, investment banks, and issuer that is offering its first ever bond is called as debit issuer. If the bonds can be sold through an underwritten offering or best efforts offering. Underwritten offering bond issue price is guaranteed by the financial intermediary. Issues that are not underwritten are considered to be best efforts offering. Underwritten price secured by GS. Price not guaranteed. Price not guaranteed by GS best efforts. It will charge a commission. commission is in the bonds. In self-reserve bond issue is registered with securities regulators and its aggregate value and master prospectus. Bonds can be issued over time and the issuer needs to raise funds. Yeah. Usually require weeks of road shadows. Underwriting plan to issue date. To introduce investors to the debut issuer. The subsequent repeat issues of a fixed income usually take much less time for investment grade fee. The time between transaction between being agreed and being completely allocated to investor may be a matter of hours. Issuer. Among investors, we have electronic trading markets, we have dealer market, we have over the counter. Trading in secondary market remains in the dealer or over the counter. Dealers post quotes, prices, ask for bids. The difference between bid price is dealer spread. Bid and ask is dealer spread. Distressed debt is a name given to bonds of issuers that are expected to file for bankruptcy. Investor might buy the debt from other institutions or profited from owning securities and aims to profit from issuers' fortunes of reversing. Working capital are most likely raised through issuing. Required by corporation to finance investment in seasonal working capital. Seasonal working capital. Why? Commercial paper. Less than money. Compared to equity indexes, aggregate fixed income are most likely to have lower number of constants. Each of the private market transactions has a commission bank, sell bonds on a commission basis. Underwriting offering. Secondary market bonds are most likely takes place. Dealer markets. Bond transactions. Secondary bond market transactions. Dealer or organized exchanges. Secondary bond market transactions. Sovereign bonds are described as on the run when they are on the run. When is this? Where is this on the run? I think I've missed this on the run. Most recent issue of the specific maturity. What? 3 is what? First is C. Best efforts offering later. weights are more higher than overall, more constancy lower than. ठीक है fine. On the runners, all balls are on the run. Conducting a yeah, opening of an existing ball. Setting at highest bit offer, most likely a highest bit offer, most likely a what is this? This is a fixed income issuance and trading. Let's see the important questions from this. So yeah, pitfalls. Front is stressed. Resolution, not recognizing. Of matching benchmark characters in portfolio. Alternatives available to corporations and financial institutions. Short-term funding for non-financial corporations, non-financial company usually raises external funds for investment in short-term assets. for corporate issuers, short-term funding for non-issuance. So we have certificate of deposits, negotiable, non-negotiable, is sold, not sold. Central bank, fund market of reserves, cash balance. Some banks have excess reserve. Lending of this reserve value is equal to central bank's funds rate. Interbank funds. So in external loan financing, we have different. Means the person doesn't have any limits to the amount of credit he gets from the bank. Extends an offer of credit for principal amount, usually charging a floating rate plus a fixed credit spread. The credit is uncommitted in the sense that the bank may refuse to lend if circumstances change. As a result, this is less reliable than other two types. However, it is likely to be flexible agreements with the bank, regular, typically 50 basis points or something like that. Offering commitments for less than 1 year maturity of an agreement. They may withdraw at maturity should credit conditions. Banks typically place restrictive covenants on borrowers such as agreements. Fees rates are similar to committed line of credit. Companies backed by collateral. Companies can assign receivables to lenders to act as collaterals. And then factoring refers to actual transfer of credit, granting and collection of receivables to a lender at a discount from their face value. The size of discount which represents interest rate on the loans. It's small period, and then they are usually CP to replace maturing paper is termed as. The company cannot issue new CP. Cannot issue. Borrowers may. So similarly, single payment bureau commercial. This commercial liquid commercial. This commercial liquid international market in commercial deposits have a stated term and interest rate. These must stated term and interest rate. These may take form of an interest-bearing certificate of deposit which pays interest at a specific negotiated of deposit which pays interest at a specific negotiated. CDs are an deposit have stated term and interest rate. They may have funds that are loaned by one bank to another are referred to as interbank funds. Funds that are loaned by one bank to another are referred to as interbank funds. Banks lend to each other for periods of 1 day to 1 year. One bank to another is interbank funds. Okay, fine. We have market reference rate. Most common type of secured interbank borrowing and is carried through repurchase agreements, which we discuss later. We saw this interbank MRR when we defined the coupon paid by funds as being equal to variable MRR plus a fixed margin in a stable. The MRR can be used as a starting point for other stable. The MRR can be used as a starting point for other riskier loans. Source of short-term funding for open market operations and by the availability of short-term funds. This will likely to be at a higher rate than the central lending extra. So financial institutions issue more commercial paper than non-financial companies. Financial institutions often sponsor non-commercial, short-term often another entity. Initial margin to protect the lender against potential risk. Consider from the date